Generally speaking, macro is irrelevant for what most of you do, but I do believe this presentation is in fact very relevant because what we tried to do, and as a matter of fact, before we get started, can I, by show of hands, who of you guys, or how many of you have heard of the fourth turning, perchance? A show of hands.
Fourth turning?
Yeah.
Yes, sir.
Well, by the end of this presentation, and certainly by the end of this decade, you all will be very familiar with that concept. It's currently a New York Times bestseller book. My former colleague, Neil Howe, he and his partner, Bill Strauss, wrote a book about 20 chronicles a lot of the change in the social mood that has led to the current political environment. And ultimately, that political environment is likely to have very big economic and market implications over the long term. So we put out a big study on historical fourth turnings to give us a sense of how that's likely to play out over the next decade or so. So without further delay, so what the fourth turning is a sequence, it's a framework for thinking about how the economy and asset markets evolve through the lens of generational archetypes. There are four generational archetypes, and when they align in a certain pattern, as they are currently aligned now, we wind up with what we call a fourth turning. And these patterns, this cycle, this longer term cycle, typically lasts of about the length of a long human life. It's called a saeculum. We are currently in a fourth turning. The last three fourth turnings that we've experienced in this country have all coincided with total wars. So we had the Great Depression, World War II, in the most recent fourth turning. We had the American Civil War and the previous fourth turning prior to that, and the American Revolutionary War and the turnings prior to that. Howe and Strauss have done a tremendous amount of work on this, studying Anglo-Saxon history all the way back to the 1400s. And this pattern has been recurring since then. So I do believe this has a lot of stickiness and persistency as it relates to forecasting what might happen in the future. So what we did was we did a long-term time series analysis of studying all these major macroeconomic statistics to give us a sense of how the economy and asset markets are likely to evolve over the next, let's go, coming decade. So I don't believe that most things we say as macro people really matter for that time horizon. But I do believe this work that they've done and have embellished on in the most recent book, The Fourth Turnings here, which again is currently a New York Times bestseller. I do believe a lot of it has value. So we'll start with real GDP growth. And so you're going to see a collection of charts to me in this presentation that looks just like this. On the chart on the left, we just showed the long-term time series as far back as we can get the data, capping it at 1800 to not bias the sample. And we on the chart on the right, we show the summary statistics on that time series. So the blue bars correspond to the median value, the dark green line correspond to the maximum value, the dark red line corresponds to the minimum value, and then the light green and the orange line corresponds to the interquartile range for that particular statistics. And so what we find is that real GDP growth, going back and looking at the most recent four turnings, is that it's typically relatively weak during four turnings, with a little bit more volatility, particularly on the interquartile range. Nominal GDP growth also tends to be relatively weak with a lot more volatility if you look at the max-min range for this particular statistic. So we have generally slower real GDP and nominal GDP growth in a fourth turning. And again, this is a condition, a political, socioeconomic, and political condition in the society that may persist at least through the end of this decade, perhaps into the early 2030s. Headline CPI tends to be relatively strong in fourth turnings. If you look at the median value there, we put together this model about a couple of years ago that was sort of trying to address what I think they very much discussed at Jackson Hole this past August, which is, where is R-star? What's the underlying level of inflation relative to the previous trend? And this is a dynamic factor model that takes into account 20 features that have all been correlated or co-integrated with the unit root of core PC inflation across time, across multiple decades. And what we found is that relative to the 2009 to 2019 trend of 1.6%, these factors or these features, if they're correct and persistent, suggest that the underlying trend of core PC inflation has migrated to about 2.5 to 3%. And so when I say the underlying trend, obviously inflation has volatility and oscillates, but that underlying trend has gone from about 1.6%, at least according to our model, to somewhere around 2.5 to 3%. And so that's consistent with the analysis that we've done with inflation time series going back to the 1800s that suggests that inflation not only tends to rise, but it's persistently stickier and higher in fourth turning environments. And keeping it moving, the employee compensation tends to be relatively weak during fourth turnings when you analyze it on an employee compensation to gross domestic income based on a ratio basis. Corporate profitability tends to be relatively strong relative to that baseline of first, second, and third turnings. In fourth turnings, you have a little bit more volatility, not only in the interquartile range, but also in the max-min range as well. S&P 500 earnings growth tends to be relatively strong during fourth turnings with more volatility. you tend to get a little bit more earnings growth on a median basis, a lot more volatility, which tends to make sense. Again, fourth earnings have a lot of geopolitical implications, and we'll get to that towards the end of this presentation. S&P 500 returns tend to be relatively strong during fourth earnings as well, and so you get a little bit more return for taking along additional units of risk in these events, and we'll talk about exactly why, given sort of the decline we see in GDP growth relative to that baseline. Valuations tend to be relatively stable in fourth earnings. So we're analyzing my former professor, Bob Schiller's, his CAPE ratio. That number tends to be pretty stable on a median basis. 10-year nominal treasury yield tends to be relatively weak during fourth earnings and actually quite weak relative to the baseline of first, second, and third earnings. The real treasury yield tends to be quite weak relative to that baseline in fourth earnings. The 12-month nominal T-bill yield tends to be relatively weak during fourth earnings, and the 12-month real T-bill yield not only tends to be relatively weak, but it's also negative on a median basis in fourth earnings. So there is a significant amount of financial repression that we should expect as investors, but that's how we all get rich as investors, if we can take advantage of that. Nominal home price growth tends to be relatively stable, so this is not a real asset phenomenon. We typically see the concentration of returns in financial assets in fourth earnings. Real crude oil price growth tends to be relatively stable during fourth earnings as another indication that this is not a real economy phenomenon. This is a financial economy phenomenon in terms of the impact that fourth earnings have on asset markets. And then part of the reason for all that impact when we transition a little bit and start looking at, okay, why are these outcomes occurring in financial markets? The sovereign fiscal balance tends to deteriorate sharply during fourth earnings. And so the sovereign fiscal balance as a percent of GDP, it's on a median basis. It's much weaker in fourth earnings, but it also tends to decline. So when I say relatively weak, relatively strong, that just means relative to the baseline of first, second, and third earnings. When I say decline or rise, that means there's a consistent and persistent pattern across these longer term time series of certain events taking place. And what we tend to see is a sharp reduction in the sovereign fiscal balance as a percent of nominal GDP in these fourth earning events. Sovereign debt, obviously, as a consequence, tends to rise materially in fourth earnings. You typically see that as well, with a much higher sovereign debt to GDP ratio in fourth earnings relative to the baseline. Taxes tend to rise materially during fourth earnings. So if you look at government revenues divided by GDP, we typically see that rising during fourth earnings, and obviously it's much higher in fourth earnings relative to the baseline. We also see government expenditures rising as a percent of GDP pretty sharply in these fourth earning crises. And they are called crises for a reason, because they typically coincide with some large existential crisis, whether they be physical or just due to our general way of life. So we know that the government tends to get much larger in these fourth turning episodes. So that's something we have to prepare for as investors in terms of finding a way to not be victims of financial repression, but to actually take advantage of the financial repression we're going to experience. The public interest burden tends to rise materially during fourth earnings. So this is government interest expense as a percentage of GDP. That number tends to rise pretty sharply during fourth earnings. We believe it's on its way higher now. Obviously, we've left a pretty historically low interest rate regime, and we don't believe we're going back there. At least this analysis would suggest we're probably not going back there. The U.S. dollar tends to be relatively stable when you analyze it on a median basis in terms of its annual change versus gold. But we have seen some pretty sharp devaluations during fourth turning events. And so we expect not only financial repression, but we also should see some currency debasement as well over the next decade as a consequence of these burgeoning sovereign debt deficits. OMB projections, pick your institute projections of where the budget deficits and debts to deficits are headed. And that's all very consistent with this fourth turning regime that we're currently in, and it's likely to persist for the next decade. Income inequality tends to be relatively strong during fourth turnings. And it's not just because it's going up, but really because that's part of the conditions that create the breakdown in the social mood to create the fourth turning and the political instability that we typically have. So part of the process of a fourth turning, Neil would say, is getting the economy back to a more equal playing field, not just for different classes of society, but mostly through the lens of generations, so that the young can have an opportunity to grow. So that's part of this redistribution process. Fertility rates tend to be relatively weak during fourth turnings. Fertility rates for every major economy have been declining for hundreds of years. So that's not new news. I think the presentation's off.
Oh, it's
Oh, gotcha. Yeah, the fertility rates tend to be relatively weak during fourth turnings. That's not new, or sorry, they've been declining for hundreds of years for every major economy. So that's not new news, but there's a pretty significant decline relative to the baseline throughout these fourth turning periods. And part of that, obviously, total war being a contributing factor to that. And then lastly, second to last, immigration tends to be relatively weak during fourth turnings. If you look at it relative to the baseline. And then lastly, trade tends to decline meaningfully during fourth turnings. If you look at the trade to GDP ratio for the U.S. economy, that's something that we are currently experiencing now with deglobalization. If you look at trade to GDP, I want to say it peaked back in 2007, and it's been on a trending decline since, and we do not expect it to recover until we get out of this fourth turning. So a lot of the tit for tat that we're seeing with China, some of the tit for tat, obviously, we're seeing with Russia and other parts of the Middle East, that's going to get worse, unfortunately. And it may.
Where's commodities in this picture?
Gotcha.
And which commodities?
So I looked here on slide 53. We analyzed the real annual change in the real crude oil price.
Not crude oil. I'm talking. Sorry, agricultural commodities.
Oh, we don't actually.
We don't look at those. What about gold?
Gold. We have dollars value versus gold be the inverse of that.
What is the correlation of fossil fuel oil to the inflation rate? The lack of price of fossil fuel goes up because we're not producing fossil fuels. Is there a correlation to that, to the interest rate?
Oh yeah. So to the interest rate. I'm
not
sure
sorry,
I understand your question.
No. To the inflation rate. The correlation of oil to inflation. The higher the oil price goes, the higher inflation, but that's self-induced.
Yeah, there's
There's
about
a correlation of that. What percentage of inflation is caused by the oil pricing?
Oh, so
2%, 5%, 10%, 50%.
The correlation to the change in the inflation rate the last time I did this study was probably several years ago, but it was about 30%.
30%
Yeah.
impact on inflation.
Yeah, the pass through from the change in crude oil prices to the change in inflation is about 30%.
Wow, that's big.
Yeah, it's pretty big. Yeah.
So you could cut, if you start producing oil, you can cut inflation down by 30%.
Perhaps. Although going back to our secular inflation model, I don't know that crude oil in and of its isolation is the only factor that we need to be concerned about in terms of the higher trend of core PC inflation.
No, I agree with that.
Yeah, there's other wealth effects, a big deal. The change in wages are a big deal. We've also seen the blowout in the budget deficit, commodity prices, deglobalization. There's a lot of factors that are contributing to a higher underlying level of core PC inflation that I don't think we're going to be able to ascertain until we get into the next business cycle. Because we know we're all probably headed back to somewhere between 2.5% inflation. But the problem is, do we bottom at 2 and start to reaccelerate from there? Or do we actually stay at 2 persistently? Our model is suggesting that we're not going to stay at 2 persistently. It's somewhere closer to 2.5 to 3 on core PCE, which means headline CPI is somewhere between 3 and 3.5.
Well, the actual inflation rate, you're talking annually, but then if you accumulate that over the past several years, the inflation actually impact is something like 15–16%.
Yeah, I wouldn't disagree with that. Yeah, absolutely. So yeah, just to wrap up this presentation, and then we'll take questions obviously at the end of this. There's a couple more slides I wanted to wrap up. So just summarizing the key fourth turning risks: stagflation, lower growth, higher inflation, fiscal crisis, much deeper budget deficits, much wider public debts, much higher expenditures as a percent of GDP, revenues as a percent of GDP. The government gets larger. Financial repression as a function of the government getting larger. Currency debasement as a function of the government getting larger. These are avenues that every public sector, going back to the ancient Romans, has figured out how they can deal with their own public debt issues. So we would expect to see some version of that, and I will explain specifically what versions we expect to see on the next couple of slides.
When was the last fourth turning?
Last fourth turning was the Great Depression and World War II. So again, so I didn't want to bring that up because macro guys have this bad rap for being doomsday sayers, and I am not a doomsday sayer. I'm incredibly bullish because of all these features, and we'll tell you why in the next 2 slides.
Darius is extremely optimistic guy compared to our regular.
No, God, yeah, no. How many macro economists does it take to screw in a dark light bulb? Anyway, so investors should expect monetary debasement. Because the private sector will continue to demand higher yields to capitalize the government. And the reason I say that is because if you decompose the sort of main cohorts of buyers for the marketable treasury market, there's a Federal Reserve there at 20% of the total marketable treasury market. U.S. commercial banks are at 16%. Both of those numbers are declining, both from largely because of policy, the change in monetary policy. And then if you look at the black line, which is the foreign official sector, they're now down at 15% from as high as 40% in 2008, 2009. So this is China, Saudi Arabia, Russia not wanting to hold our assets. And as a function of that lack of demand from the foreign official sector, and obviously you layer on the change in monetary policy here in the U.S., we, the purple line, the private sector, have had to capitalize the government at an accelerating and alarming rate. We've gone from around 36% of total marketable treasury debt outstanding at the end of 2021 to 48% of total marketable treasury debt outstanding currently. So that's obviously why we've seen treasury yields back up from around 2.5% to somewhere, north of 4% on the 10-year, north of 5% on the 2-year. So we would expect to see, if our inflation model's right, the Federal Reserve has a choice to make. And this is what they were debating at Jackson Hole. Chairman Powell came out very, harshly against the idea that the Fed is going to have to change their 2% inflation target. But we are going to take the over on that. The reason we're going to take the over on that is because if they do not take the over on that, and they continue this pattern of fighting the tide and of burgeoning treasury supply, the purple line is going to jump off the page. And if the purple line jumps off the page, we're talking about 6-7% treasury yields. I'll show you a quick chart before we get back to this presentation. The reason I say we're going to 6-7% treasury yields, when you decompose the bond market into all sort of core features, between term premia, inflation expectations, term premia are still currently running at minus 41 basis points on the 10-year. If you go back and you look at the long-term mean of term premia since the early 1960s, it's at about 152 basis points. So you could back up close to 200 basis points in the treasury yield just to get back to normal levels of term premium. We also have inflation expectations that are very neatly anchored at right around 2.25%, whether you look at market-based or implied inflation expectations. And if our model is anywhere in the area code correct, those numbers need to be close to 3.25 on inflation expectations. So right there, you're talking about 275-ish basis points of rates of 10-year that could be priced into the 10-year just based on having a higher trend level of inflation. So going back to this discussion, I'll wrap up and open it up to questions. Going back to this question of whether or not the Federal Reserve decides to change their 2% inflation target, we happen to think they will when the unemployment rate's high enough for them to do so from a political standpoint. But if they don't, we're going to wind up with some form of de facto QE anyway. Because all we really care about is somebody else buying the bonds, not us, in terms of the private sector. And we happen to believe that commercial banks will be increasingly relied upon to finance burgeoning treasury deficits. So in this chart here, in this top panel, I'm showing commercial banks' treasury and agency securities as a percent of their total bank credit. That's about 24% of the total. Going back to the late 1940s, during the last fourth turning, that number was 64% in terms of their treasuries and agency securities relative to their total bank credit. Now, this sort of bank credit metric is a pretty oscillator, outdated metric. Obviously, we like to look at things as a share of total assets, but we don't have asset data going back beyond the mid-1970s, so we have to make a few inferences. And so the ratio between bank credit and bank assets has been fairly stable across time. The mean is right around 78%. And so if we go back and we sort of apply that mean to this sort of peak ratio that we experienced in the late 1940s, we can get commercial banks' assets to about 50%. Or 50% of their assets will be denominated in treasury and agency securities. That number is only about 18% now. And so we happen to think that if we have some sort of crisis, whether that be a public debt crisis, some sort of total war, some sort of, I don't want to pretend like we have a real crystal ball of how this crisis is going to unfold, but we do know where we're headed from the perspective of these burgeoning sovereign debts and deficits. And the crisis could just be the entitlement crisis that we're obviously walking ourselves into. So as I mentioned, commercial banks are only about 16% of the treasury market now. They've been as high in terms of as far back as we can get the data as 30%. So either way, it's going to be the Fed changing its inflation target, which will allow it to keep interest rates much lower and financially repress us and do more QE as the economy slows, or it'll be commercial banks through regulation and regulatory schemes to force them into higher shares of their total assets in the treasury market. So how this is good for you guys as investors, as long as we find one of these two agents to replace us on the purple line, that means dollar's going to go down, stock market's going to go up. Pretty much any asset that isn't tethered, any financial asset that isn't tied down is likely to appreciate as a function of that financial repression and currency debasement. So you got to be extremely bullish because everything is so bearish.
If the banks have to buy more paper, treasury paper, does that displace other things that they own or buy? What does it displace?
Yeah, absolutely. It will crowd out capital in the real economy. And it's typically when you see the best sort of returns in paper assets is when the economy is struggling. Typically, when the GDP is above a trend on a median basis, you typically have lower equity returns, and most of the equity return tends to come from earnings growth. You tend to have more valuation expansion when you have below trend growth from below median growth in terms of this analysis that we perform.
what percentage of debt does China own of the United States is debt? Because we're essentially, by paying that interest to them, we're essentially financing their economy and or their growth and or their military.
Yeah, I mean, you can make the case that, I mean, if you look at, so PBOC's assets are around $3.7 trillion. I mean, it's estimated that about 3 trillion of that is US Treasuries, which means if you just single balance sheet analysis, about $3 trillion of the currency floating around the Chinese economy is effectively backed by US Treasuries. So they're not going to dump anytime soon. That would tighten financial conditions to a very draconian degree in their economy. But we do know that in aggregate, and obviously China's the lion's share of foreign FX reserves, in aggregate, that's about 15% of the market, treasury market.
50%.
Total.
Yeah.
So China's
tremendous
guessing somewhere 2/3 of that.
Of their economy.
Yeah.
And or their growth and or their military.
Yeah.
So we're actually paying them against us.
We can get into that as well, but yeah.
Anyway, this is very fascinating. I think we have time for about one or two more questions. So, so does raising tariffs and drilling oil again help the U.S. economy, or you have any thoughts on that? Or
yeah, of course. I mean, there's going to be mitigating factors to any crisis, but the reality is it's based on Neil's work, and I have a lot of tremendous confidence in the work that he and Bill Strauss have performed, and I think a lot of other investors do as well in terms of adopting this framework as a general guide to the longer term outlook for the economy. You're not going to be able to change the relationship between the generational archetypes. The millennial generation coming into power and replacing the aging baby boomer demographic is going to create this political instability that is a sort of necessary ingredient to this fourth turning. It's also a necessary ingredient to fixing all the problems in the fourth turning and creating a much more harmonious society that allows us to grow at a much higher rate on a longer term basis. But we sort of have to go through the path of perdition to get to that positive outcome. But what I'm effectively arguing is that because of financial repression, because of likely currency debasement, that path of perdition from an economic standpoint and a political standpoint actually is likely to be quite positive from a financial asset standpoint. Generally speaking, we're studying, longer term financial cycles.
People, it's always like going to be different this time.
Of course.
But I wonder, things are quite different now in terms of technology and globalization are the two that keep coming to mind as you go through the presentation. How do you see the more interconnected global situation, the more, technologically driven relationships between economies? Is that an amplifier? Is that a volatility inducer? Or kind of how does that, if we're trying to project forward into this turning, how can we see that impact manifest?
No, I would happen to think it's a mitigating factor, if anything, but it's also probably not, because if you think about studying this through the lens of financial market panics, low volatility regimes beget high volatility regimes. And so the sort of integration that we've had together over the past several decades, particularly in the post-war era of greater and greater economic cooperation and integration is similar to a low volatility regime in financial markets. And it creates the seeds. The unraveling of that actually creates the seeds of a much higher level of volatility from an economic standpoint. So I would argue, as positive as that might sound, it might actually be the cause of some of the volatility we experience economically and geopolitically.
And I know you don't see the rates going. Is that,
No, that seems to be unlikely. And again, there are mitigating factors. That's why I put the secular inflation model table up as well. Technology is one of those mitigating factors on inflation. The money velocity, things of that nature. There are mitigating factors for why we're probably not going back to 12, 19, 18% inflation. But again, in the current regime, relative to a 2% inflation mandate, which we all kind of taken to believe it's right around 2.5%, if we are persistently trending above 2.5% to 3%, that means we're going to have to change monetary policy, or we're going to have to change regulatory policy in a way that allows banks, either central or commercial, to buy treasuries so that we, the private sector, can get back to capitalizing businesses. Okay.
What part of the fourth turning are we in, and when do you expect we start to adjust ourselves in that fourth turning?
Gotcha. So it's not me. I'll lean on Neil's work for as well. Yeah. So we're currently in the crisis phase of the fourth turning, Neil. so he seems to believe that the cycle is likely to culminate, reach its sort of climax phase in the late 2020s, early 2030s. That's when you're likely to see, you know, some large scale geopolitical and or socioeconomic event sort of, you know, cause us to go from constantly picking sides and bickering with each other to saying we need to band together to fight for our survival, either physically or existentially, or from a cultural standpoint.
So not even within the next 12 to 18 months.
No,
Much
absolutely.
longer
No,
term.
much longer term. This is a much longer term roadmap to thinking about the next decade of investment.
Wow. Okay.
Yeah, you know, I think that a lot of people, there's a chart that's rolling around that shows that money printing from central banks all around the world has kind of gone asymptotic since 1970 something,
Mm-hmm.
right? Like every central bank is printing relentlessly. And so, you know, the question is, how do you get back into, you know, more favorable economic fundamentals, right?
Well-
I mean, I don't know, I prefer fundamentals over hyperinflation.
No,
Call me crazy.
well, you prefer to make money, Marty. Let's be totally honest. Yeah,
Real money.
yeah, fair enough.
Not
Yeah,
hyperinflation.
exactly.
I mean,
I'm effectively arguing that because of this, the geopolitical and economic instability that we're likely to experience over the next decade, we are going to turn into some light version of Turkey, Argentina, and all these Venezuela. You know, you go pull up those stock markets; they have very, very outstanding returns, obviously on a nominal basis. And I'm effectively arguing that that's the path of least resistance from a political standpoint, from a policy standpoint, in terms of dealing with this fourth turning crisis. So, told you, got to be bullish because you're bearish.
So do you want to wrap it up, give it a minute or two and tell us about, you know, your fundamental perspective and what?
Also, can you tell us about your services, what you offer, how much do you charge? Is there a newsletter? Is there consulting? Do you do special projects?
Oh, all three of those things. So this wasn't meant to be a sales pitch, but I'll take it as an opportunity anyway. So again, as I mentioned, 42 Macro, we specialize in quantitative macro risk management solutions for mainly the buy side asset managers. We work with family offices. We work with some RAs as well, and some high net worth individuals. But I spent most of my career on the sell side and finance, and so that's kind of my bailiwick, is putting together book reports and traveling around the world and presenting them like this. Does anyone have any questions on the cyclical economic outlook? Because that's obviously a much longer term.
Is this ballpark the subscription? What's the fee cost?
Oh, consulting, we're at 5,000 a quarter. But to just access our written research is around $200 a month. Appreciate everyone's time. Thank you so much.